They have about $76,000 in credit card debt. Let's look at doing velocity banking to see if we can help their cash flow problem. Their monthly income is $7,440, and their total monthly expenses are $7,467, leaving them negative $27 for the month. Now, if we look at the whole overview, this is how velocity banking looks. We take our income, we pay our cash expenses. Cash expenses are anything that cannot be paid with a credit card. These have to come directly out of your bank account. So as soon as you get your check, you pay your cash expenses first. On this planner, we have the cash expenses listed in red. You can plan this on paper like this, or you can do it in a planner. Sometimes the planner is easier for seeing when your credit card statement dates close. So we take the income, we pay the cash expenses first. We pay everything else to the credit cards. This satisfies the minimum payments. Their minimum payments on their credit cards are $2,386 every month. So the $4,906 that we pay is going to cover that. Then we're going to be charged interest on all of these balances. So that's about $1,500 per month. Then we have $3,400 left to pay the remaining bills. Those are about $2,500. This leaves $854 that these balances should go down. The hardest part about this is staying disciplined in what you're using your credit cards for. We have some extra stuff down here, and we're not going to go over that right now. So we have the paydays listed, we have the cash expenses listed in red, we have everything that can be paid with a credit card listed in blue, and then we have all of their credit cards here with their statement dates. Before we decide which bills we're going to put on each card, let's look at these expenses over here. These expenses are their miscellaneous spending, medical, and their subscriptions. So all of these expenses here, and then their food and their gas. With the subscriptions, we can put those on the planner to decide which credit card we'll use to pay them, but I didn't know the dates, so we're just gonna combine them all over here. So we have $1,640 for the miscellaneous and spending. We're going to divide that by 4. This is $410 per week. So $410 needs to go on the cards every week. But you have to make sure that you're sticking to this number. These things here are where it's very easy to go over in the budget. Normal monthly expenses like this are easy to plan because the payments are usually around the same amount. It's the extra spending that can get us in trouble, so be extra careful. So they don't have any credit card statements closing before these bills here are due. So what we do is look at the previous month. So we're in October now. The end of September, they have a statement closing, probably around the 28th. That's the Wells Fargo card. I would put these expenses here on this card. So anything the first couple weeks of the month, you're going to use a card that closes at the end of the month if you don't have another credit card statement closing during these days here. Then these bills here can probably go on the American Express card. It should close around the 14th of the month. But then we also have to decide where we're going to put the extra spending. So let's take a look at that. First, let's break down each paycheck, and then I'll show you what it looks like to pay and use each one of these cards. They were also considering taking out a 401k loan. I'll go over that and a financial hardship program for the credit cards at the end. So they have a paycheck on the first. The total for that is $3,470. So the first thing we do is check for any cash expenses. In this case, it's just the mortgage of $1,800. So we pay that first. So the mortgage, $1,800. This leaves $1,670 that we can pay to the credit cards. Then we go through and look and see what credit cards we have to pay during that paycheck. So the Amex Platinum, the Amex Gold, and the credit union. Remember, I said these bills here will probably go on the American Express card because that statement probably closes somewhere around the 14th of the month before these bills are due. I would probably also put one of the weeks of spending on that card. So we're going to do the $410 for the spending, plus all of these bills here, which total $243, plus we have to pay $85 for interest. So $410 plus $243 plus $85. So let's say we just round this up and we pay $750 to this card. So the Amex, we're paying $750. Now the Amex Platinum, it probably doesn't close until around the 15th. This would probably be one of those cards that I would not use. The minimum on this card is $286. I would probably just round up and pay $300. One more thing you have to consider when you're using American Express cards to pay bills, sometimes your bills won't allow you to use your American Express to pay them. So before you plan to put those bills on that card, make sure you can go in and pay them with the American Express card first. Most bills you can, but occasionally there will be a bill that you can't pay with a certain credit card. So just double check that. Now the Amex Gold, same thing. I probably wouldn't use that card. And your American Express Gold card does not show utilization. So if you're focused on your credit score, getting this card paid down is not going to positively impact your credit score. So that minimum payment is $238. And again, I would probably just round up and pay $300 to it. Now the credit union card, it has a lower interest rate and I would probably use it for another $410 for spending. Let's see what we have left over here. So 1670 minus 750, 300, $320. So that's not going to cover that whole $410 in spending plus the interest. But if we look at this card, it's due on the 13th. The statement probably doesn't close until somewhere around the 19th of the month. So we get another paycheck between the time the due date is and the statement closes that we can add more of a payment. Now let's look at the second paycheck. This one is $3,970. Again, we go through and look for any cash expenses. In this case, that's the car payment and the IRS payment. So the car is $659 and the IRS is $75. This leaves us with $3,236 left to pay to those credit cards. Remember I said we're going to pay the credit union again, so we're going to write that here. The credit union, we have the US Bank, the Wells Fargo, and the Chase card. So remember our statement hasn't closed yet. For the credit union card, we get paid again. So let's add another $500 before that statement closes. So we're going to pay another $500 here. The Chase card, I would try not to use this card anymore. The interest is higher and so is the balance. So let's say we pay $700 to this. The minimum payment on the card is $616. So we'll be paying slightly over the minimum. The US Bank is another one that we can do the $410 in spending on. The interest on that card is $295 or around that. So if we do 410 plus 295, we need to pay at least $700 to that card. We are going to pay $836. And then we'll pay the remaining to the Wells Fargo card. So we have 3236 minus 500 minus 836 minus 700. We have $1,200 left to pay the Wells Fargo card. Remember, these bills here were going to go on that card. Those bills total $665 plus the interest, which is about $245, and we also need $410 in spending to go back on this card also. So 410 plus 295 plus 410. So these bills here total $1,115. Now let's look at how much the card balances are going to go down when we do this. Before I go into that, I do want to mention the financial hardship program now. So remember, out of all of the cards, we weren't using these couple cards here. Most of your credit cards have a program where you can call and get financial assistance, usually through a financial hardship program. What that does normally is lower your interest rate and your monthly payment. So in their case, I would probably at the very least do this with the Chase card. The balance on that card is $18,769. Right now, their interest rate is 26.5%. So their monthly interest is around $414. Now let's say they lower your interest rate down to 12%. $18,769. That would bring the monthly interest payment down below $200. So it would go from $414 down to about $188. So that's around $200 more that's going towards the actual balance every month after they lower the interest rate. The only problem with doing this is sometimes when you do the financial hardship program, they require you to stop spending on the card. But in the example we had, we weren't going to use the Chase card anyway. And it is one of the cards with the higher balances, so it's probably going to be harder to get that balance paid down. You could do this with all of the credit cards if you wanted to, but that would probably eliminate your ability to do velocity banking because a lot of these cards won't allow you to continue spending after you're in that program. I know with Discover, they do usually allow you to keep spending, but most of these cards here, I don't believe that they will. So that's just an option. Now these balances here aren't as high, so I may not do it with the Amex cards, although I do know that they have the program. The credit union was at 11%, so that one you probably wouldn't have to do either. In this case, these two balances here are the largest. We could just do it with those two cards and use the remaining cards for all of the other bills. We were going to use the US Bank card for some spending, but you could put that on another card if you wanted to. You could use the credit union card twice for that. So that is a really good option if you're looking to lower your interest rates, but do be aware they may stop you from spending on the card. And with the financial hardship programs, it's usually for 6 to 12 months. So it's not a permanent solution, but you can make a lot of progress in that amount of time. Okay, now let's look over each card individually. So we have the American Express card here. The balance is $34.98. we were going to pay $750, and the interest was about $85. So $34.98 minus the $750, we add the interest back in, plus $85. So this is what that balance should report around, $2,833. $2,833, that's what it reports at. Then after that, we put the bills and spending back on the card. The bills and spending totaled about $653. So the balance goes back up to $34.86. So the balance only went down slightly from where we started, but we knew that was gonna happen. We just planned for spending on this card. We weren't really planning for that balance to go down yet. And you can always change the amounts that you pay to the cards. Maybe you wanna pay less to that Chase card and pay extra during this paycheck to get that balance down on the American Express. There's many ways that you can plan this. Amex Platinum, the balance is $8,695. We were going to pay $300, and the interest was around $210. We were not using this card in my example. So we do the $86.95 minus $300 plus the $210 for interest. So the balance would report at about $8,605. So here we had the balance going down about $12. This balance went down about $90. The Amex Gold was the same thing as the Amex Platinum. We weren't going to use it. The balance was $6,513. We pay $300. And then they charge us interest, which was about $157. $6,513 minus $300 plus $157. So $6,370. So that balance went down about $55. The credit union, this was one of the cards that we were using, and it does have the lower interest rate at 11%. The balance is $10,586. We were going to pay $320 during the first paycheck. We were going to pay another $500 during the second paycheck, and then we add back in the interest, which on that card is probably around $100. So 586 minus 320 minus 500 plus 100. So we're at $9,866. The spending that we put back on the card was $410. Now watch how much this balance goes down. So we're at $98.66 plus $410 after we put the spending back on the card. Now the balance is at $10,276. $10,276. So this balance went down about $310 that month. So we have these cards going down slightly. This one went down a lot. The Chase card that we weren't going to use, $18,769. We were going to pay $700. And then we add the interest back in, which was about $414. So $18,769 minus the $700 payment plus the $414 for interest. We're at $18,483. So $18,769 minus $18,483. It went down $286. $286, and we were not using that card. So that balance should just continue to go down. And then if we do the financial hardship, we lower the interest here. More of the $700 payment goes to paying off the balance. So this would be closer to $500 per month that the balance would be going down on that card if we were to lower the interest. The US Bank, we were at $17,456. We were going to pay $836, and the interest was about $295. This puts us at $16,915. This was another card that $410 in spending was going back on, which brings the balance back up to $17,325. This balance went down around $131. Then we have the Wells Fargo. Remember the Wells Fargo card, the statement closes at the end of the month. We're going to use it for $410 of spending, and then these bills go back on it as well. So we were at $10,417. We were going to pay $1,200. The interest comes back on before the statement closes, $245 for interest. This puts us at $9,217. Then remember we had $1,115 for spending, $10,332. So the balance here went down $85. So you can see if we stick to what we plan to spend all of the balances on all of the cards are going down every month. That is what we want, even though some of them are a small amount. And you can play with the numbers. Maybe you don't want to pay so much to this card here. Maybe you want to pay this to one of the other cards to have those balances get lower faster, since this one has a lower interest rate. But you also have to pay attention to how your credit card statement dates line up with your bills. The most important part of this is sticking to what you have planned to spend. But if you're paying more to the cards than what you need to spend back, your balances will be getting lower every month. And the balances on the cards that we are using are going to report quite a bit lower to the credit bureaus, which in turn helps the credit score. So the US bank card, the limit on it is $19,000. So currently it's at about 92% utilization. Once we make this payment, let's see what happens. The balance is going to report at $16,915 divided by 19,000. So that balance then goes down to 89%. This doesn't seem like a lot, but every small amount that you can get that utilization down on each individual card is going to help. Now, there was one more thing that they were considering here. I already went over that financial hardship program with the credit cards. That is not a bad idea, especially if they were to do it just on a couple cards. They thought about doing a 401k loan to pay down some of the debt. This can be a good option to lower interest if you have your spending under control. Let's say they take $10,000 out of the 401k loan. This is the problem. They pay off $10,000 of credit card debt. That would be good. But a lot of times what happens when we take a large chunk of money and pay it to a card, we don't have our spending under control. So now we have a 401k loan. We have a credit card balance that goes down to zero. Just say they pay off one card. The problem is if we don't have our spending under control, we rack up the $10,000 in credit card debt again. Now we've doubled the amount of debt that we have. This is not the worst idea, but you have to be very careful of how you do it. I suggest if you're going to borrow money, especially from your 401k, that you make sure for 3 to 6 months, your balances on all of your debts are getting lower first before you do this. Even if it's just a small amount, you want to make sure that you're spending less than you're bringing in. If the card balances are currently going up every month, I would be very careful of doing this. If it were me, I would probably not do the 401k loan, at least yet. Maybe do the hardship for the Chase card, possibly one or two others. If you want to, call them and see what the program looks like. Then assess your situation over the next 3 to 6 months and see how much you're paying your balances down. I personally think the best way to get out of debt is to just buckle down and get the debt paid off. Just like with 401k loans, a lot of people do the same thing with personal loans where they take out a personal loan to pay off their debt and then they end up racking up the debt again. So then they owe again double. So that's not something that you want to do. It's really not a fun place to be in. So just be very careful of that. And one last thing, she also asked if they had an extra $1,000 per month, what could they do with it? Personally, if it were me, I would split that payment up, even if it was just $500 to this card and $500 to this card. This balance is pretty low. We could take the whole $1,000 and pay it to that card and have the card paid off in 3.5 months. But that extra $1,000 can just add to the amount that the balances are going down on all of these cards here. They have 7 cards. They could pay $100 extra to each card in that case. Again, there are many different ways to do it. The main focus should be getting the balances down on the credit cards. And if we're using all of the credit cards like this, we're lowering the credit utilization, which is helping our credit score. I know we covered a lot here, but if you have any questions about Velocity Banking, credit cards, credit scores, or anything else, let me know.